Hello guys, welcome back to the channel. Today is Sunday the 18th of December 2016. Now I'd just like to make people aware I don't always get notifications of every single comment that comes through, and this particular comment I only actually stumbled across when I went back into a video to answer another question and then saw this. And this comment came from Paul Whiffen. Silver the Antidote, have you seen this? Amazing and totally criminal. And the short response is, no, I haven't seen this particular article, but the topic that is covered, I do refer to it from time to time, and this is referenced obviously in some of my previous videos. But nonetheless, the article is a great analogy of how people need to remember what it is that we are dealing with when we are investing in the silver markets. And the author, Theodore Butler, puts a great slant on it for people to visualize what the actual correction phase should look like. And this is the article here called The Royal Flush, which comes from 24hourgold.com. So thank you to Paul for submitting this one. And obviously I'll read this out to you guys. This is published on the 15th of December. In order to make a point, I'm going to address a very popular question by giving the answer first and then providing the question. The answer does involve a bit of imagining on your part. I ask you to picture yourself at the highest stakes poker game imaginable, where quite literally many billions of dollars are at stake, and in which you have just been dealt the indisputable best hand possible, a royal flush. Please accept that you are guaranteed to win. It's the last deal of the game, with winner takes all. The pot is enormous, and all the other participants have been dealt very high and normally winnable hands, and are flush with funds, and every player is intent on raising and re-raising as each new bet is made. You have plenty of betting funds left, and know that you must win in the end. So it is obvious that you will sit back and enjoy the circumstances and hope the raising and re-raising will continue for as long as possible, making the once-in-a-lifetime pot as large as possible, tens and hundreds of billions of dollars. The most popular question in silver, and the one I ask myself daily, is when will JP Morgan finally decide it holds enough silver and let the prices rise? The answer is only when it has to, by virtue of its massive physical holding of silver, which is more than 550 million ounces and growing. And that's the part that I'm referring to, as I've covered in other articles, but my figures were around the 500 million. JP Morgan has as much incentive to rush the price resolution as you would have to end early the imaginary poker game. JP Morgan has been guaranteed to win the real silver game of a lifetime ever since its physical holding came to exceed its COMEX paper short position, a threshold it crossed in late 2011 or early 2012. Ever since then, JP Morgan has sat back, content to add to its physical silver holdings at decreasing prices, because it knew it must win in the end. As much as a royal flush in poker, silver is guaranteed to be a huge winner for JP Morgan for the simple reason that the bank controls the market. Don't believe me? Then try explaining how it is possible, since acquiring Bear Stearns in 2008, that JP Morgan has never taken a loss, only profits, on every COMEX short silver position it has ever taken, all while being the largest short holder. Not only does JP Morgan have a perfect record on the short side of the COMEX silver futures for nearly 9 years running, for the past nearly 6 years making paper profits in the billions of dollars by shorting paper contracts was not even the bank's greatest achievement. That honour must be reserved for JP Morgan's accumulation of more than 500 million ounces of actual metal, all on price declines it rigged itself. Based upon those two circumstances, it is possible for any entity to demonstrate greater control over any market than JP Morgan has done in silver. What's more remarkable about what JP Morgan has achieved in silver is that it occurred in full view. Certainly, a review of JP Morgan's financial performance in shortened COMEX silver futures based upon commitments of traders, COT, data, reveals the bank never took a loss or bought back short positions at prices higher than originally shorted. Normally, holding massive short positions on a volatile commodity like silver would be thought to be very risky and lead to losses at some point, at least once in a while, except, of course, if the game was rigged. As the largest and most successful short seller in the COMEX silver futures over the past 9 years, JP Morgan was the unquestioned primary silver price rigger. But JP Morgan is so smart and powerful and crooked that it figured out an even better means of enriching itself. Apart from the billions of dollars it made in shorting COMEX silver futures cumulatively since March 2008, the successful and profitable short-selling campaign that JP Morgan orchestrated in COMEX silver is predicated on declining prices. There's no way massive short selling can be profitable if prices rise instead of falling. Further, even if you succeed for years in successfully rigging prices lower, as I claim JP Morgan has done, sooner or later prices will fall to such ridiculously low levels that they then must rise, most likely in the same ridiculous manner in which they fell. At some point, the jig would be up on the downside rig job. This is so basic that it would be foolish to think it would be lost on JP Morgan, the smartest player of them all. JP Morgan knew when it started to acquire physical silver in April 2011 that this was the only way it could successfully conclude its widely profitable long-term shorting campaign in COMEX silver futures. The only thing it couldn't know was how much physical silver it could acquire before the COMEX paper shorting scam ran its course. But there was no way the bank would ever pull the plugs on its control of the COMEX price discovery process while there was physical silver still to be acquired. Not while it was holding the best royal flush ever. No one would end the game early in these circumstances, and it is unreasonable to expect JP Morgan to do so. Therefore, silver investors are better advised to focus on the quote what end quote instead of the quote when end quote. Although I will admit this falls into the do as I say and not as I do category. Besides, since when can anyone ever know the quote when end quote? The quote what end quote is easy. Silver is as cheap as dirt because it has been paper shorted into the ground, and on top of that, there is a compelling evidence that the premier world financial institution has amassed more of it on a physical basis than any private entity in history. Over the past few years, I've tried to outline from where JP Morgan has accumulated its historic hoard of physical silver. Conversions of shares to metal in the Big Silver ETF, SLV, of which JP Morgan is the custodian, led the way, but there were important sources of supply from skimming the highly unusual COMEX silver warehouse movements and direct purchases of silver eagles from the US Mint. Interestingly, all these sources of actual physical supply to JP Morgan began around the same time, April 2011. Not the largest, but clearly the most transparent source of physical silver supply for JP Morgan has been in deliveries against COMEX future contracts, from 0 ounces in April 2011 to 5 million ounces in April 2012, and on to more than 80 million ounces today. The COMEX silver warehouse of JP Morgan has become the largest in the COMEX system. This year, JP Morgan has taken delivery of more than 6,000 net silver future contracts, of which, guys, each contract represents 5,000 ounces. So it's 5,000 times 6,000, which is another 30 million ounces. Contracts stopped minus contracts issued, all in its own proprietary trading account, most of which eventually found its way into the bank's COMEX warehouse. What is truly remarkable when you study the data is how glaringly dominant JP Morgan has been in stopping silver deliveries this year. Last year too. And he links over to the CME Group report for the yearly settlements in deliveries of physical metals globally. Shortly after the COMEX December delivery commenced earlier this month, I estimated that JP Morgan may stop the maximum number of silver contracts allowed in a single month, 1,500 contracts or 7.5 million ounces. As it turns out, through yesterday, JP Morgan has already taken over 1,400 silver contracts. JP Morgan last stopped the full 1,500 contracts allowed last May and took less than that amount in the 4 other trade and delivery months of the last year, excluding the current month. Previously, I had attributed JP Morgan stopping less than the full number of silver contracts allowed on those occasions to the bank not wishing to tighten the wholesale physical market to the point of sending prices higher. Therefore, I was somewhat surprised when it became clear that JP Morgan intended to take so many silver deliveries this month. Then it dawned on me that the main reason JP Morgan stood for so many silver deliveries this month is because it knew that one of its customers would make a sizable silver delivery this month of nearly 700 contracts, or half of what JP Morgan stopped in its own name. At the least, JP Morgan had to know before anyone else that its customer would make such a large delivery, and also knew that the 700 contracts involved would add to physical tightness, giving the bank a green light to take many more contracts than in more recent months. Like so many other things, JP Morgan acquiring silver in its own name from a customer suggests a strong conflict of interest and quite likely stinks to high heaven. The big stinker, of course, is the bank being the dominant COMEX paper short, never taking a loss and driving silver prices lower for years on end, while being the largest stopper of COMEX silver deliveries and accumulator of physical silver of those same depressed prices. Remember, I am basing this on public data from the CFTC and COMEX, and if you have any questions about this, please let me hear from you. I would also ask you to consider, in what faraway universe would JP Morgan's actions be considered proper or legal? The bottom line on all of this is that silver will go when JP Morgan deems it so. There's nothing we can do to affect the timetable, so it's counterproductive to even think in those terms, although it sure is natural to think that way. There is only one way to handle an event that is certain to occur, but at a time that can't be pinpointed. Be prepared for the certainty beforehand. JP Morgan's downward manipulation of the silver price in order to accumulate the largest hoard of silver in history further assures the outcome. The whole manipulation is somewhat complex until fully vetted, but the preparation for it is as simple as it gets. Buy and hold silver. For the better part of the year, up until the past month or so, the principal measurement I consider, the COMEX market structure in silver and gold, had been bearish. The record large commercial short position and corresponding managed money long position, which peaked in the summer, led to me calling the structure extremely bearish on numerous occasions. I didn't claim to know how it would turn out, just that it must be resolved. And if it turned out how it always had in the past, prices would move lower. That was then, and this is now. Now the market structure is no longer extremely bearish or bearish at all. It is bullish or extremely bullish, depending on how many more managed money traders can be persuaded to sell longs or add shorts. That doesn't mean we can't have sell-offs, including sharp ones, like today, that made it seem like the selling will never end. But the reality is that there is a limit to the selling, and that limit is reached quicker when trading volume swells, as is also the case today. There are sharp rallies this summer in gold and silver, even though the COMEX market structure was bearish. But eventually prices turned lower and the structure was reversed. Likewise, even though the market structure is now bullish, sharp price declines can and do occur. However, the prospects for much higher prices is always best when the market structure is bullish, as I believe it is now. Add in the fact that JP Morgan is buying both physical metal and paper COMEX contracts, and the best hand is to bet on silver moving much higher. Ted Butler from butlerresearch.com. So obviously we're all aware of what's happened this week when that article was written. The silver price was obviously hit extremely hard. And if we go back to a yearly view, you can see we've pretty much lost half of the gains that were made at the peak of the year. But this is always what it's about, guys. If we take the 5-year look, going back from 2011, or as close as we can on a 5-year scan, the general trend during that whole process, in fact, let's just take a look from the 20-year. So we're going back from 2011, April of 2011. Supposedly, this is the time JP Morgan starts to buy large. And throughout the whole period, it's been slowly pushing the prices down. Obviously, the spikes, but a lot of this will obviously be also making paper profits off of people thinking the prices are going to be rising. And then they just pull the rug from underneath anybody inside of that paper market. And then obviously buy up the physical on the way down. So it's a double-edged sword that JP Morgan always win, regardless of how you play it. The age-old saying, if you can't beat them, join them. Well, if JP Morgan are acquiring massive, vast amounts of physical silver, of the expectation that there's going to be a serious price correction, especially when you have derivative market explosions and the fiat currencies become an untrusted source and something is going to have physical, tangible backing, you're going to see parabolic revaluations. So there was another question sent in to me, which was, have you seen the price of silver on the US debt clock? And the answer is yes. Here it is down here, based at dollar to silver ratio now, claiming that each ounce of physical silver is valued at 1,003 US dollars. But if you put your cursor over it and you see the top description of what it is, it says US dollar to silver ratio. The year-over-year increase in the US M2 money supply divided by the yearly world production of silver. And the sources for this information are the USGS and the Federal Reserve, both totally inaccurate places that lie about figures. But nonetheless, we have no other way of really gauging it because we don't have the intel, so we just have to take that as a prediction. But these are always undervalued or under-documented. So what that means is they are calculating the year-on-year increase in monetary supply into the system. So down over here inside of this green box is the money supply symbol. This lower one, which is titled M2 Money Supply 2000. M2 consists of M1 plus savings deposits, small denomination time deposits, individual retirement accounts, IRA and Keogh balances at depository institutions and balances in retail money market mutual funds. And this one above it, which is M2 Money Supply and percentage increase since 2000. So from the year 2000 to the year 2016, that accounts for 13.273 trillion of the 20 trillion US debt, which, let's be honest, is most of Barack Obama's term. So they are dividing this amount here by the silver production for the year. So what it is effectively saying is, with the mass creation of money divided by how many available ounces there are, the true price based upon their mathematics and the USGS and the Federal Reserve data is stating that it will be 1,000 per ounce. And obviously the numbers go the same for the gold. So if you imagine JP Morgan are aware of this data and they are suppressing the price from spiking during the 2008 crash, which created the huge rally obviously into the silver and gold markets, and that was cut prematurely short with a fresh injection of stimulus into the economies, all the while JP Morgan having more time to acquire the metals during this time, knowing that at some point in the future parabolic increases are going to be occurring purely because of dollar debt destruction and physical availabilities of real assets, which they obviously hold large volumes of. So I'm going to change this into the US dollars just to make it a bit more understandable, because obviously that's what we're dealing with. So at the peak of the US dollars, if you were buying it at $46 and it's now all the way down to the $15 mark, well, if you're looking at selling it somewhere in the region of 1,000 plus, which if you control the markets and you can manipulate them down, there's no reason you can't manipulate them up, especially, like Ted says, when it's time to sell. Buy cheap, sell high. That's how they operate. So anywhere in this region, and anywhere in this region, is a fantastic time to be buying and accruing what is likely, via the Cliff High Webbot report, a generational wealth transfer. And he's not talking about a 100% move, a 200% move. You are talking 1,000% gain. So right now, JP Morgan are controlling the precious metals prices, manipulating all the mining companies to produce these metals at extremely low costs so they can acquire them. Why own the mine and go through the whole production costs when you can just manipulate the market to the times that you want to be acquiring the physical, which is quite likely what happens. So I think it's clear to anticipate that the likelihood of holding, even if the time isn't in your lifespan, to acquire these generational wealth platforms, these generational wealth transfers, then it should be your legacy to your family, to your children, to pass down this information and what you have managed to acquire in your lifetime, and educate your children in the reasons to be holding it until such a time as these markets flip the other way. It's probably extremely unlikely for the majority of us to make any gains, even remotely close to the opportunity that is presented before us today with holding physical silver. And this should hopefully give you that little bit of confidence in knowing what you are holding is of true value. And anybody that tells you, oh, you should have sold when it was at $20, at its peak. This is a long hold. This isn't a quick, short, get rich quick scheme. This is for the astute investor that understands the market and understands the manipulation that cannot continue in the debt cycles that we live in today. And every day that prices remain at this level should be seen as a godsend to increase on your position every opportunity that you get. It's really that simple. And if you don't understand that, then you really are in the wrong place and shouldn't be watching these videos. Anyway, guys, this is just hopefully a realistic, motivational video that will help you understand and feel that what you are investing in and holding is going to have its day. We just don't know when. Thank you so much for watching.